Hello everyone. Today we will be studying about the topic final accounts of a sole trader. Let us understand the meaning of final accounts of a sole trader. When we say the final account, it means preparation of the financial records of an organization. And these financial statements are prepared for a specific period of a time, generally one accounting year. When we say sole trader is a type of a business organization wherein a single person is the sole owner. He is a sole proprietor, he is a manager, he is a decision maker of a business organization. The features of a sole trading organization is this type of a business is considered to be a one-man show business. Single proprietor, single person is responsible for all the losses of the business. Single person is sharing all the, he is the sole person who will be sharing all the profits of an organization. The risk of a sole trader is unlimited to the extent of the business organization. Need of a final account. Let us understand why the final accounts are needed. As per the accounting standards, each and every organization has to maintain their books of accounts. So, to have the true and fair views of the organization, to know the net profit of the organization, to know the net worth of organization, final accounts are prepared by an organization. Final accounts are prepared for a period of 1 year. Normally, 1st January to 31st of December could be an accounting year, or it can be 1st April to 31st of March of the next year can be the accounting year. As we have discussed, this is the period for which final accounts are prepared by an organization. Let us understand the accounting treatment with regards to the final accounts of a sole trading concern. When we prepare the final account, basically we prepare with the trading account. Trading account, we record all the direct expenses of an organization, or you can say all manufacturing production expenses are recorded in trading account. Next, we have to prepare profit and loss account, all the indirect expenses of a business organization. It can be indirect expenses or indirect incomes are recorded in profit and loss account. We record the next as a balance sheet. Balance sheet is considered as a financial statement which is prepared as on one particular date to know the financial position of concern as on one particular date. Trading account and profit and loss accounts are considered to be the accounts, the ledgers which are prepared for a particular period of a time, whereas balance sheet is prepared as on one particular date. Let us understand the format for the trading account. As we have discussed, trading account, we record all the transactions of a direct expenses. You can see here in the format opening stock, purchases, freight inward, direct wages, carriage inward, factory rent, factory lighting, heating, repairs to plant, depreciation of a plant, salary of work manager, sale, closing stock. All the direct transactions are recorded, direct headings, expenses are recorded in trading account. The next one is profit and loss account. The format, you can see here all the indirect expenses of business like rent, office lighting, repair, maintenance, depreciation, salary, rent, printing, stationery, postage, telegram, interest, all indirect expenses we record on the debit side of profit and loss account. On the credit side, we record for gross profit, discount received, commission received, rent received, interest received. All transactions are recorded on the credit side. The balancing amount of profit and loss account is called as a net profit, whereas balancing amount of a trading account is called as a gross profit. Moving to the next is the balance sheet. Balance sheet is prepared as on one particular date. So when we prepare the balance sheet, first on the liability side, we record capital of a proprietor, net profits, if any, from the P&L account will get added, net losses, if any, will get deducted, drawings will get deducted, interest on capital will get added. Then we record for bank loan, outstanding expenses, creditors, and bills payable. On the asset side, we record for furniture, building, plant and machinery, prepaid rent, debtors, bank, cash, balances, closing stock. Few transactions, I have given you the list of liabilities and assets to be recorded on the balance sheet. So here all these headings would be given to you in the trial balance. From the given trial balance, you have to see which particular ledger account or the balance sheet that particular heading will be recorded. In the final account, they will be provided you with adjustments as well. All the adjustments has got two effect. One is debit effect. The second is the credit effect. Whereas the items which are shown in a trial balance will be having only one effect. Let us understand this. First, we have a closing stock. Closing stock is recorded on trading account credit side as a one effect. Second effect is recorded on balance sheet asset side. Closing stock will be given as a part of adjustment. Again, closing stock cost price or a market price. If the values are given like this, we have to consider the one with the lowest one is considered to be the closing stock. Outstanding expenses, these are the expenses which are due but not yet paid. These add your balance of expenses. So if outstanding expenses like salaries, wages, printing is given to you, it has to be added to the concern expense either in trading account or in a profit and loss account. Second effect will be shown in balance sheet liability side. Third adjustment is for prepaid expenses. Prepaid expenses are expenses which are paid in advance, like insurance premium. Generally, we may pay this in advance. So if such adjustments are given, it will be deducted from the concern expense and it will be recorded as an asset. The next one is depreciation. Due to regular wear and tear, value of assets get reduced. So for that, we provide for depreciation. So depreciation reduces the value of asset. It is to be calculated at the rate of certain percentages which are given in the question. Depreciation also will be calculated for the period for which you have used that particular asset. Effect of depreciation, one will be deducted from the balance sheet on the asset side. Second effect, either it will be recorded on trading account or it will be recorded on profit and loss account debit side. The next is reserve for doubtful debt. These are the provisions which we make. Generally, these reserves are considered to be given in the form of percentage. So every year we maintain some percentage as a reserve for doubtful debt. We are doubtful whether the money could be recovered from the customer or no. So on the debtor's value, we have to provide this RDD ka percentage. One effect will be recorded in balance sheet asset side. RDD percentage will be deducted from the value of debtors. Second effect, we have to show in profit and loss account debit side. Under the head bad debts, the new RDD or new doubtful debts will be added. In case if any old bad debts are given in the trial balance, that will be deducted and net amount will be recorded in the outer column. Unrecorded sales. This is an adjustment. Sales have been done, but entry has not yet recorded in the books. These are called as an unrecorded sale. Effect for this will be added to the trading account on credit side. It will be added to the sales. Also, the other effect will be recorded on balance sheet asset side. Under the head debtors, unrecorded sales will get added. The other adjustments, income received in advance. These are the incomes which we have received in advance. So, one effect will be recorded on trading a P&L account credit side. The second effect will be recorded on balance sheet liability side. These are the pre-received incomes. Next adjustment, interest on capital. Interest on the capital of a sole proprietor or a sole trader. This will be recorded on profit and loss account debit side. The second effect is added to capital in balance sheet liability side. The next adjustment, goods lost by fire. Generally, goods lost by fire is considered to be the loss for the business organization. If such losses are there, effect will be recorded on trading account credit side. The whole value of the goods lost by fire will be recorded. If no insurance claim is there, the entire amount of a loss will be again recorded on debit side of a profit and loss account and will be shown as a loss by fire. If the question gives you some amount of a insurance claim, in that case, claim is the money which we have received from the insurance company. In such case, goods loss by fire will be recorded on trading account credit side. Amount of insurance claim will be recorded on balance sheet asset side. And the difference will be considered as a goods lost by fire, which is recorded on profit and loss account debit side. Next adjustment, goods distributed as a free sample. Sometimes organization may distribute some goods which are considered as a free sample. So when such adjustment is given in the question, effect will be recorded on trading account credit side with the entire value of goods will be shown on the trading account credit side. The same value of a goods will be recorded on profit and loss account debit side and it will be shown as a free sample as a part of advertising. So all these adjustments we have to consider. We have to check with the trial balance postings. Once we have done with the trial balance posting, effect of adjustment, we will tally the question and gross profit transferred to the profit and loss account. Net profit from the profit and loss account will be transferred to balance sheet. And lastly, we will tally the balance sheet. Hope the concept of a final account of a sole trader adjustment concept is clear to you. Do share, like, and subscribe. Thank you for watching.